Good afternoon, viewer. The purpose of this video is to explain living accommodation taxable benefit. So this kind of topic is usually tested in ACCA, ACA, or CT exam. Also useful for employer who um, provide a house for living to their employee. They wish to know what are the taxable benefits. So if an employer provide a house for an employee by the reason of employment or to their family, so there are taxable benefit. There may be taxable benefit because there are some exemption. So in the following video, I would explain exemption. There are certain rules. It's good to know those rules, because if you don't know the rules and just learn the formula, it's not going to help you, because that's why I'm keep telling the students or those individuals interested in the UK employment taxes is to visit HMRC website, legislation, understand the concept, the rules. So if an employee is working with an employer and he's been given a house because of the reason of employment, so and then obviously certain other benefit, for example, the employer pay their electric charges, council tax bill, water. So this would also result in additional tax benefit. So this employee receiving a salary plus bonuses plus additional benefit. So the salary and the bonuses usually get taxed on the payroll. This house benefit, most of the employer, they would like to report them separately on P11D form. So the P11D form is used to report those benefits. So any additional taxes. So once you submit P11D form, so that is by 6th of July following the tax year in which the benefits were provided. So all these benefits would go on that P11D. So the housing benefits or the living accommodation benefit is one of them. So the HMRC would know from that P11D form, because on the P11D form, what we're reporting is the name of individual, and the date of birth, national insurance, and the address, and the relevant benefits. So the HMRC would clearly know which employee received the benefit, because everything is electronic. So the employer would pay any employer NI by 22nd of July, says after 15 days. The employee would pay any additional income tax at the marginal rate. For example, if they are subject to 40%, so they would pay 40% taxes on those additional benefits. So the following slide would explain how, well, the rules, the exemption, and there are various rules. So please go through each slide, and then if you have any question, so drop me a line and I would explain to you in more detail. I try to cover all the topics. Just make sure, because you understand as an examiner, or even if you're working with a company and your client asks you a question, so there are very useful information. So please stay with me. So what living accommodations? What are living accommodations? So if a house owned or rented, it doesn't matter, is made available to employee or their family member by reason of employment for living, this may be a taxable benefit. So what we're saying is maybe a taxable benefit. So there are some exemption available. Any household expenses relating to living accommodation that covered by the employer will also give rise to a separate tax benefit. For example, council tax, water bills, furniture. So very important for you to understand this one. What are the exemptions? So exemption is, number one is if it's provided in connection with the a performance of duty, so such as, for example, security guards or a caretaker. So security guard, obviously, if their premise, for example, if the company is like on one side and the security guard has been given an accommodation across the road just to make sure that that he can be easily called if there's any emergency, or a caretaker has been given accommodation. So this kind of accommodation usually exempt because it's reason of employment. So there are other two factors you need to consider as well. Was it necessary? Yes, because then it can be called anytime. It's more convenient. A caretaker, instead of taking bus or taxi, wasting time in the traffic. So usually they get house accommodation by the employer close to the workplace. So better performance is usually, yes, that is the case of better performance. For example, a house given to a priest. So a priest would come and do their own jobs, or imam for the mosque. Yes, so these kind of accommodations, they are exempt. Living accommodation for a director exemption. Yeah, there is a director exemption. So then, however, it's only those director which working for a charity company. For example, a company built for a charitable purpose, for no other reason. Okay, so for example, if a company, other company, known than other than a charity, provide accommodation to their director, yes, the director will be subject to income tax. The company would pay employer NI. There's no employee NI on the benefits. Then there's exemption still continue is so for example, there's another exemption, like there's an employee A living far away because his own house is far away, and there's a threat that usually some employee finish work 11 o'clock or 12 o'clock midnight, and they are unable to go home, and there's a threat, and then obviously for some reason the employer decided to I mean, there are certain employees, so obviously employer want to keep them or wish to keep them, so any accommodation provided for that reason, for security reason, that is also exempt as well. Local authority provided accommodation. So for instance, there's an employee coming from Manchester, he works for, say, Lewisham Council. In UK, in London, there are council. So the local council, if he works for a local council, and the local council usually provide accommodation at a deep discounted rate. So the market trend currently, like in London, and any part, even if you go a bit further, so for 2-bedroom flat is in the range of like 2,500. In central London, it could be like £6,000-7,000 per month. So, and then, but the local council, if you are their tenant, for example, some of the property belong to the local council, and then if you become their tenant, so you usually get a 60-70% discount, and same is like for building association. They offer like 30-40% discount, and to their own employee could be more discount. So, but then it should be on the basis that other borough, so for example, Lewisham, Camden Town, all these things, so they have the similar rule for their tenant as well. Not like that you want to make someone happy. This is not going to work. Rule should be even for all the borough. Exemption still continues. So for example, there's an overseas holiday home owned through a company. Yes, there is exemption available. However, there are certain rules. So for example, condition is that overseas property must be the company only mainly asset, and the company can have no activity other than those incidental to the ownership of the property. The reason I'm explaining all these things, because in exam there must be some like tax planning questions, so you can really talk a lot. You can do at least 2-3 pages. So if they have some kind of question, or there's a long question could be as well, like can break it down, especially in CTA exam. They would test you like in every single aspect that you really, because if you want to be a chartered tax advisor, so really what the examiner want that you should know it all. If someone asks you a question, not like I know the basic and I don't know the advanced, or better you know it all. In an ACCA exam, it's unlikely that some of the technical topic would be tested. Maybe in ACA or CTA they would, but still it's better to know, and it will be very easy for you as well. So then taxable benefit if accommodation rented by employer. So there's a short lease, less than 10 years. So there's so we need to choose the higher, obviously is not owned by employer rented from a landlord, and then pass it to the employee, so the employee living or their family member living. So then the way we need to calculate is we need to choose the higher of the rent paid by the employer and the annual value of the property. So choose the higher value first, and then from there you deduct the employee contribution. So for example, if employee required to contribute money towards the rent, yes, this deduction is available, so it will lower the tax bill. This is an example here. Mr. Alex is provided with a flat. Okay, his employer leased the property for a period commencing. The employer paid a premium of 30,000, pays a rent of pay rent of 5,000 per month. The annual value of the property is 10,000. So the taxable benefit. So in the past, like some of the employer took the advantage. What they did is they leased the property. Say for example, for 9 years, they pay the higher lease premium, and then they will tell HMRC, the tax authority, that look, we pay only rent. So what will happen is instead of paying rent, they would pay high lease, and then they would pay lower rent. They would like to protect mostly a director in any country. Obviously, they want to be like more because they already pay so much taxes. So obviously, they want to find their ways, but HMRC keep blocking this kind of things that they say it's not lease premium is also. So if a lease premium, you need to consider that as well, plus the rent. So in this case, so you cannot dodge it. So then in this case, choose the higher. So rent paid by the employer plus the lease. So the lease is for 6 years. So then obviously, and 30,000. So divide by 6, obviously, and then multiply by, because it wasn't available. So make sure that the property was available for the entire year. So then obviously 12 divided by 12. There's no proportion, but if it's available partway through, okay, so then you need to proportion the month. And the same is the rent was, so in this case, the rent was 500. That's just an example. So the total is 8,250, and the annual value of the property is 10,000. Therefore, the 10,000 worth of benefit to be included on P11D for Alex, because you need to choose the higher amount. Then the other could be, there could be a case of where accommodation owned by the employer. So in that case, so obviously the annual value plus, because the accommodation owned by the employer, so there will be 2 charges. The other one was like rented by employer, so usually it's cost to employer the rent. So in this case, the ownership, this result 2 charges. So number one is we need to look at the property worth more than 75,000. So the cash equivalent of the benefit is the rental value of accommodation less any amount made good by the so then in this, if the cost of accommodation exceeds 75,000, so there will be additional charge arises equal to the official rate. So the official rate will be given to you in your tax table. And then, sorry, there's some grammatic error, but anyway, so I will explain to you the concept. So, and they need to calculate 2 charges. So on the following screen, I would explain how to calculate those charges. So when you're calculating the cost of property, only those improvements done before the beginning of the year are taken in account. Okay, so make sure that you consider that one as well. Any improvement during the year will affect the cost used in calculating the benefit of the period. Okay, so deduction is available for employee contribution. However, if contribution exceed the amount of benefit, no loss will arise. It's unlikely these days because in UK, the property value just keep increasing, not just in UK, in every part of the world. So it's unlikely that the property value would go down. So in the following screen, so the way you need to calculate is like, so annual value plus additional yearly rent F cost more than 75 times by, so this is the rate which will be given to you in tax table. So this is an example. So if an employee live in accommodation owned by his employer, so the house cost of employer, the cost of employer 200,000 so initially, and has an annual value of 10,000. So the 10,000 value, pick that one first, and then obviously it's it's cost employee more than 75,000. So there will be obviously another charge which is called additional yearly rent. Then the way it's on a P11D, you need to report like annual value, which is 10,000, additional yearly rent. So that will be 200,000 minus 75,000. 75,000 is the baseline. So any result from this one is the rate. I assume it, like I said, the official rate of interest which will be given to an exam. So that, and then less any contribution paid by employees. So the total taxable benefit will be 7,750. Six-year rules. So there's another rule, for example, the most tested in exam is usually a scenario where a property is first made available for use more than 6 years after it has been acquired by employers. So acquired by employers like 6 years ago. So in such case, additional yearly rent is not based on cost. Instead, the charge is based on the market value of the property on the date it was made available to the employee. So if this is the rule, so the cost of any improvement between the valuation date and the start of the tax year for which the benefit provided, less any employee contribution should be added and calculated in calculating the additional yearly rent. So the following skill I will show you how it's work. So number one, like for example, if an employee was provided with a house by his employer in June 18, so that he pays 500 a month rent for use of the house. The house was purchased for 180K in 2015 and has an annual value of 10,000. So then, and this house has a market value of 250 in June 2018. In June 2020, the employer paid for extension to be added, costing 20,000. Assume official rate is 3%. So in this case, so the starting point is annual value and then the additional yearly rent. So obviously you can see this one, the house is owned by the employer more than 6 years. So make sure that you pick up the market value plus any additional extension and then minus 75,000, which is the baseline, multiply by 0.03 and they deduct any employee contribution. So the taxable benefit reported on P11D is there. So if the market value for some reason falls below the original cost, okay, so then still you need to use the market value. So make sure that, but it's unlikely it will fall below. But in case the examiner tests you, so always choose the market value if this 6 years rules apply. Household expenses, if the employee pay for gas, electricity, council tax, okay, water, repairs, cleaning, etc., provided, so or furniture or domestic, so this will give rise to additional separate benefit based on the cost to the employer. Separate rule for exempt accommodation, for example, a priest, with a salary of say 20,000. So then we need to, if any benefit we added, like all furniture in this thing, if we added and appear to be like 2,500, so you need to restrict it to 10% of his salary. Thanks for watching. If you have any comment, I'm happy to answer your queries. And if you feel like, you can subscribe to my channel. And I would add more video. This would be based like on beneficial loan. I will also explain voucher, so it will help you to understand the employment tax, and slowly I will progress to corporation tax and VAT and inheritance tax. Thanks for watching. Bye now.